Hey everybody, Joseph Gozlan with Eureka Business Group, and today we're going to talk about how we do valuations for industrial properties. We'll start with the formula. The formula is pretty basic. It's the same formula we use to evaluate every commercial real estate property. It's NOI divided by cap rate equals value. What does that mean? NOI is net operating income. Cap rate is capitalization rate. Don't worry, we're going to cover every single one of those in a second. And then value is what we think the property is worth at the end of the day. So let's start with breaking down the formula. First, what is NOI? NOI stands for net operating income. Net operating income is broken down to two separate pieces. One is the operating income, and then the other one is the operating expenses. We keep saying the word operating and not just net income or income less expenses because there is a difference. We start with looking at the right side about the operating expenses. This is the regular operation of the property kind of expenses. This is things that happen all the time, every week, every month, every day, every year. But every is a repeating kind of thing. This is normal operating expenses. So anything from repairs and maintenance and the utilities and property taxes, insurance, advertising, admin, property management, and so on. These are all stuff that happen on a regular basis. What we don't see over here is things that happen every once in a blue moon. So if I have a roof leak and I need to repair it, that's repairs and maintenance. But every once in a few years, I have to replace the whole roof. Maybe I had a hailstorm, maybe I had some kind of a damage. If I have to replace the whole roof, that is a big expense. That is not normal operating. That doesn't happen every year. So we don't count that in the operating expenses. The rule of thumb to look at it is if it costs me more than a few thousands of dollars at once, and that's not the big expenses like property taxes and insurance that are repeating, then I'm going to take a look at it and say, okay, is it something that belongs in the normal operating of the property, or is it unique? If it's unique, it's not in the operating expenses. On the left side of this table, we see the operating income. Operating income is every single dollar that I can collect and put into the bank account, whether it's rent or it's reimbursement of expenses. Sometimes, depending on my lease, and that's the key word over here, is what's in the lease. In commercial real estate, the lease is what's going to determine what you're going to get reimbursed for. And some properties can claim almost anything, or some properties actually claim everything, from property taxes, insurance, repairs, maintenance, utilities, securities, and so on. So make sure, and this is one of the most critical things in commercial properties, is that you read the contract, you read the lease, and you know exactly what is the responsibility of the landlord and what is the responsibility of the tenant. Let's take a look at a couple of examples for the NOI calculation. So let's say I have a triple net lease. It's a single tenant, big warehouse, good great tenant, and the lease says zero landlord responsibility, which means everything gets charged back to the tenant. We look at the expenses. We have repairs and maintenance, $20,000, utilities, $34,500, property taxes and insurance, altogether totaling $94,600. On the left side, I'm looking at my income. My base rent is $287,000, and my triple net reimbursement is basically all the expenses, and I get the $94,600. So my total gross income is $376,700. So how does my NOI look like? Remember, the formula is operating income less operating expenses. In the above example, we look at the NOI, $376,700 less than $94,600 of expenses gives us an NOI of $287,000. Not surprisingly, my net operating income is matching my rent because I'm getting reimbursed for all the operating expenses. Let's take a look at another example, a double net lease. A double net lease, if you look at triple net stands for taxes, insurance, expenses. That's each one of those ends. So if we have a double net, that means one of the ends is not covered. And in this case, we're looking at a multi-tenant flex building. Maybe I have 6, 7 of them. And let's say they have a little office up front and they have a warehouse in the back. So the leases, in this case, just a random example, says that the tenant is going to reimburse the landlord for taxes and insurance, and everything else is the responsibility of the landlord. We're looking at the expenses. It's the same example from before, $20,000 for repairs and maintenance, utility bills, and so on. But this time on our income side of things, we're only seeing $40,000 and 100 as being reimbursed, and that's a total of the property taxes and the insurance, because that's what's in the leases. So my total income is now 327 100, and when I'm looking at my NOI in this example, my NOI is 232 500, which is dramatically lower than what we had before. Not surprising again, because I'm not getting reimbursed for all of my expenses. So that's another example. If we look at example number 3, a modified gross lease with a CAM, let's say I have 2 tenants in the building and it's a storage building, and the lease says that they are going to reimburse the landlord for utilities, repairs, and they're in charge of all the repairs and maintenance, but they're not reimbursing for taxes and insurance. So if you look at the math over here, I have my repairs, I have my utility bills, that's what gets reimbursed, but I'm not going to get reimbursed for insurance and taxes. So in this example, my NOI would be the 206 930, which was the total income that I'm getting reimbursed, less my expenses. 156 500 is my NOI. So as you can see in the 3 examples, we looked at the critical factor of everything is the lease and what the lease says in order for us to understand how to calculate NOI. The other part of the formula was cap rate, which we call capitalization rate. What does that mean? Capitalization rate is something that is a percentage. Let's start with that. 5%, 4%, 3%, 2.8%. And we use that to compare apples to apples when it comes to commercial assets. Things like 2 different properties that generate the same NOI might have different cap rate, which will lead to different valuations. So in the examples we're looking at, if I have a $500,000 NOI from a property and it's being sold for $4 million, that's a 12.5 cap rate. But if I have $300,000 NOI, but I'm getting it at a $2.3 million purchase price, now my cap rate is 13%. So remember the formula, NOI divided by cap rate equals value. I can play around with the numbers. As long as I know 2, I can figure out the third. So what impacts cap rate? How do I determine what's the cap rate for a specific property? If I know the value and I know the NOI, I can calculate backwards the cap rate. But what if I don't know? What if I'm trying to figure out the value, but I am working towards understanding what the valuation is only by knowing the NOI? So what impacts a cap rate? So first of all, macroeconomy. In an economy that is expanding and things are going great and money is more available, then the cap rates will compress, they will go down because the property values will go up. In an economy that does the other way, then cap rates expanding means valuations go down. Supply and demand. If I'm in a market or an asset type that I'm looking for, let's say in the last 5 years, it's been multifamily, it's been such a hot item, then the cap rates for multifamily have compressed harder, or they went lower than they went for other asset types like office or industrial or retail. So supply and demand is critical, and a sub-market can be as influential as everything else. Just think about New York City. Downtown Manhattan is going to have a much lower cap rate than the Bronx or the Queens. Why? Because it's a much hotter sub-market in that specific city, which drives lower cap rates. And then, like I mentioned earlier, different asset classes command different cap rates. In a market where everybody's chasing multifamily, retail is going to have higher cap rates. If it's a different market where everybody's chasing industrial, then multifamily or office is going to have higher cap rates. So all those factors impact what cap rate I'm going to pay. Let's continue to talk about cap rate. So things that are critical to remember. Cap rate and value are working in opposite directions. What does that mean? You heard me say cap rate's compressing, you heard me say cap rate's expanding. So the higher the cap rate, the lower the value. Higher cap rate, lower value, and the other way around. When cap rates compress, they go down, the property value increase. We have to remember that they work in opposite directions. Let's take a look at an example for valuations now that we talked about cap rates and we talked about NOI. So if I'm looking at finding the cap rate, I have an NOI of $50,000, expenses of $23,000, asking price is $800,000. So I'm taking my NOI, which is 50 less $23,000, dividing by the $800,000 asking price, and I got a 3% cap rate. Good, bad, it's irrelevant. It depends on the market, depends on the asset, depends on a lot of different things. If I want to calculate property value, then I do the other way around. I need the NOI and I need the cap rate, and I'm going to figure it out. So sometimes you don't know what's the right cap rate. So I'm looking at operating income, let's say 750 and some change, operating expenses 350, so I can figure out that my NOI is going to be, and then I'm going to look at different cap rates. At a 6.5 cap rate, that property is worth $6.1 million. But at 7.5 cap rate, that property is only worth $5.3 million. So when I value a property, I can also give a range. Well, depending on the cap rate, it's going to be somewhere between 5.3 and $6.2 million. So I hope this kind of helped you understand the whole concept of valuing industrial properties and understanding how the cap rates is in reverse correlation to the valuation, and how we look at income, expenses, what's in the OPEX, what's not in the OPEX, what's NOI, and then how all that formula puts together. Remember, NOI divided by cap rate equals value. So that's it. I want to thank you for your time. This was a quick video. Hopefully it helped you understand. If you have any questions, or if you want to invest in one of those commercial assets, we'll be happy to help you at Eureka Business Group. My name is Joseph Gozlan. My contact details are on the screen, and looking forward to hear from you.